Welcome to another new episode of A Quest for Twice. This is a video blog of my quest to earn material amount of return through investment. So basically, my metrics are materiality, beat the market, and do that efficiently in time. So why do I think I stand a chance against the market, against the professionals also investing in the market? Because of the ownership mentality I have, and the patience I have, and the calmness. So let's take a look at the state of the current market. So this is a chart of the three major indices in the year of 2020. What you see is the bottom, the black line is the S&P 500 index. From beginning of the year to the beginning of August, it went down in March and went back up. So now it's slightly more than the beginning of the year. And the orange line shows the Nasdaq. And it's at the beginning of August, its year-to-date return is about 20%. And the blue line is the index of FunPlus. So what's FunPlus? FunPlus are the major technology stocks, including Facebook, Apple, Amazon, Google, etc. The very well-known major technology stocks. Many people look at the S&P 500 and ask themselves that oh, the real economy is doing very poorly. If I drive around, I see a lot of business are closed permanently. So how can the S&P 500 break even for this year? So it's not reflecting the real economy. So why is that? My answer is that the S&P 500 performance is driven quite a bit by the major technology stocks. So you can see the FunPlus, the year-to-date return is more than 50%, and that's driving the Nasdaq higher, and also it's helping the S&P 500 break even in this year. As the top 4 or 5 major technology stocks are about 20% of the total cap of S&P 500. So that has a significant impact on where the S&P 500 index is currently. This is another way to look at it. So what you are seeing here is the FunPlus index divided by the Russell 2000 index. Russell 2000 index is an index of the 2000 small cap companies. So what you can see here is before this year, the ratio between the FunPlus over Russell 2000 is roughly a constant. But beginning of this year, then the ratio start to go up in a pretty straight line channel, and keep going up despite the recession and also despite the economy shutdown. So that's what's really a strong indication of how well the FunPlus stocks are performing. Will this trend continue? I don't know. But I can conclude that to understand where the market is and the market trend, what we really need to do is to understand the trend of the market leaders, the major technology companies. So this slide shows the 4 large technology companies, their valuation metrics of price over earning, and you can see that for Apple, the PE ratio currently stands at 34, and it's at a historical high in the last 4 years. For Amazon, you have to go back to 2017 to see a PE ratio of 120. For Facebook, it's a similar story. You need to go back to 2017 to see such a high PE ratio. And a similar story for Google. You need to go back to 2017 to see a similar PE ratio. So in 2017, if you bought those stocks despite their high PE ratio, your investment would do very well, and because of the very great and the good earning growth those stocks are experienced in subsequent years. So currently, we also see fairly high PE ratios of those major technology stocks, and I would argue that for them to do well, we also need to see their forward earning growth, significant earning growth. Will that significant forward earning growth happen? I don't know. I guess a lot will depend on how the pandemic will develop next, and how the whole economy will respond next. Speaking of the pandemic, this slide shows the top chart shows the S&P 500 stock price in this year. The up arrows are the two purchase trades I did in terms of my nominal salary. Two down arrows are the two sales trade I did. What's interesting is I also plotted the COVID-19 daily new cases with the timeline lined up from the top chart to bottom chart. You can see at the end of April and the beginning of June, I sold 1.2 times of stocks, and those happened to be timed right before the second wave of COVID-19 cases hit the US. However, the S&P 500 actually held up pretty well and even went up slightly despite the second wave. So my conclusion is the market really did not anticipate another shutdown from the second wave, and was proven correct. So how the pandemic will develop from here, and how the stock market will respond to the future development of a pandemic and to the general election in November, those are really difficult questions to answer, and I don't have the ability to predict the outcomes either. But I still feel confident that my ownership mentality and my patience will pay off, and this will be the subject of the next episode of my video blog.